Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread show. So we're going to go through what's happening with the Frac Spread, what do we see happening on the rig side as well, and what does that mean for production in the near term, where are we seeing some of that activity. And then we had a lot of new information drop for the US. So we just want to look at what's happening with inflation, how did GDP close out, where do we see things going so far. And as we covered in on the Econ show, we looked at leading indicators, what is the Fed going to do and how can that impact things going forward. But this, we're just going to focus way more on the energy side and trying to kind of connect those dots. So on the, I'm glad to be back. I was trying to get into Canada last week and I was denied entry because my negative test expired 2 hours prior to when it was allowed to. So I was there on time, but it expired at it was 74 hours old and not 72 hours old. And then I went to go pay for a test in the arrival section of JFK, which came back positive. And I had learned that you can be positive because I had it in December. So I'm back though, and we will get to a lot of this fun information. So when we look at what's happened with the primary vision frac spread count, you can see that we are now up by 4. So we had another kind of gradual increase. It was really the Anadarko saw a big pop, some of the smaller basins, and then another addition in the Permian. And it's not surprising we're going to continue to see activity in the Permian, with just like we had another 4 rigs come in to Texas. Now, in terms of where that is, there's a broader section because Eastern Texas is also going to see a decent amount of activity. So in total, it brings us from 257 to 261. And again, continuing to climb on our way to 275. It's just the move has been fairly gradual. And I think it's important to put into perspective of what is that gradual, why are we moving in a gradual way, and have we had this before? And that's when I look at seasonality. So when I look at the seasonal increases, you can see that we typically have a strong spike going into January and then that level off into March. But the one year that really shook that trend is really 2017. And so far, we've had a very steady move up. And I think we're going to see something very similar to what we saw in 2017. And it's really because wages are still there, supply chain is still a problem. So you still have a lot of residual issues that have to get resolved or really try to manage, because some of these aren't going to be resolved, especially on the supply chain for an extended period of time. So right now, what do we have to do? We need to see refurbished equipment. We have to see some new parts and pieces coming in to make sure that there's enough to keep things going. And then you always have weather. So I think that a lot of the that slowness, we'll get that back to the 275. We're going to pause there. And as you can see, especially when you look in 2017, you can see that we had that pause in the beginning of February, and then you had that continuation. And I think we're going to see something very similar to that. We saw that in 2018 with that pause. Obviously, 2019, you had the drop. So it's a matter of just managing where things are. And obviously, when you look at 2020, which is the green line, you have Uri, where essentially everything came to an all stop. I don't think we're going to have a Uri 2, but weather is weather, as Paul Rudd told us in Forgetting Sarah Marshall. So here you can see, I think we're going to get that steady move up, and it's really going to continue to rally. But when you look at what's happening on the rig front, you have to understand, well, where are rigs? So the frac spread count's going to get you to 30, it's going to tell you what production is going to be 30 to 60 days out. And then rigs are going to be a bit more of a tell for that 6 to 9 months out. So here you can see that rigs continue to outpace. We had an increase of 6, 4 in oil, 2 in gas. But I always talk more about what type of rigs are coming to work. And you can see that there's 9 horizontal. And that's looking at the DUC count, looking at ways to replenish what's been lost, and where some of this production is going to come from, because we do expect to have an exit rate of about that 12.2 to 12.3 million barrels a day. A lot of that is going to be weighted towards the liquid side, just because of how light some of the areas are getting in Texas, especially in the Delaware. And we think we're going to get some renewed interest in Oklahoma, which again is going to be more on the liquids and wet side. So when you look at, well, what is going to drive that? This is from the EIA show, so I'm just taking this from here because I think it's important to appreciate where private rigs are versus public. And this is obviously looking at the Permian, which has been the stalwart of growth and will continue to be so through the remainder of this year and well into next year. And you can see how private operators had continued to pick up rigs, take advantage of where prices are, and public operators have been fairly slow. So we do think that you get a little bit more activity out of the public side, which again, some of these guys have their own frac spreads, which we do track and follow, which can bring back some additional activity. We do think that the publics will get more active, especially with crude at, now it's just below 87, but at $87, the curve being supportive, I think that there's going to be a bit more opportunity, especially with some of the geopolitical unknowns in the system. But on the, and this is where you always have to kind of measure what are the different components. So here, when you look at China imports, something that we talk about in the EIA show every week, it's just one of the things that we had said we expected to see a very active October, November, and then December slowdown. January is always a big month to pick up. And now you can see that things are slowing as we go into Lunar New Year. This is very normal. I'm not going to say this is abnormal by any means, and you can see that versus some of the previous times. But it's also important to see the depth of the reduction, and it's really due to the amount of Asian floating storage. But with this being said, Angola is still seeing a fairly normal, or I should say normal as guided in the last 6 months. Purchasing, Congo, same thing. Nigeria slowed a bit. But one of the interesting points that we want to look at is Urals are starting to slow down and differentials are starting to widen again, just a bit. Going from negative $1.15 to about a negative $1.50. You had a lot of buying ahead of in case things happen with the Ukraine. You had CPC issues. You had Libya. As some of that starts to come back, you start to see a little bit of the softness coming in. But with that being said, middle distillate, especially diesel, still a lot of demand. Still going to see those crudes being pulled in, but we are seeing that slowdown into Asia. Now, one of the other things that's going to impact the U.S. and Europe a bit is the widening differential between the U.S. and Dubai, or WTI and Dubai. So you can see that we're approaching $5 again. That is, you're going to see a pretty big slowdown in exports. So that will put more crude back into pad 3. And because we are targeting that middle distillate, obviously the diesel, heating oil side, we're going to see our imports pick up a bit because we're going to need to bring in some heavier barrels. So we'll have exports slow, imports increase, and that's going to be centered around pad 3. And it's something that we're seeing in Europe, in Singapore, and in other areas. So it'll be important to watch to see how some of these barrels start to shift, because Nigeria definitely has enough available. So when we look at some of the builds, things happen pretty along the lines that we were discussing. Singapore had a sizable build driven by light distillate residual. We're seeing that slowdown on the gasoline front. We're seeing that slowdown on the heavier side, while middle distillate continues to be the bright spot. You can see that things were fairly flat. In Singapore, there was another small draw in Europe, while there was residual builds in gasoline and fuel oil. Those are some of the things that we're going to continue to see. Light distillate, not a huge demand. That's going to continue to build, while diesel continues to be, again, that supporting structure. So that is going to keep, especially specific grades of crude, fairly tight versus where they are, especially coming out of ESPO, SOCOL. And then we've seen Iraq, as we said on the EIA show, Iraq has been trading at about anywhere from 50 cents to $1 above stated OSPs. So we are seeing a lot of that strength. And again, it's going to come down to the type of oil, which will be a way to make some money if you're looking at some of the places to position. Now, looking at some of the things in the U.S., we had the Fed data that came out. We discussed it in segment 2 of the Econ show, so we're not going to belabor that point. Initial jobless claims fairly stable. Durable good orders dropped. They were expected to be down 0.6%. They were down 0.9%. But then when you look at GDP came in fairly strong. It was expected at 5.5%, came in at 6.9%. And if you remember, not on the econ show and in our insights, we've been highlighting how inventory builds were going to show up, how we expected to see the retail buyer really slow down in November and December, some loosening of the supply chain issues, and that was going to result in an increase in inventories, and that came through in spades in Q4, driving a lot of that increase, while GDP price index came in it was expected at 6%, came in at 6.9%, which is a gauge of obviously price. So you can see that on an inflation standpoint, almost 7%, core PCE right at about 5%. So then when we start looking at some of the leading indicators, Kansas City kind of right in line, as we discussed with some of the others coming out of Richmond, New York, and Philly. Then when we look at employment, so personal spending missed estimates, was expected at 0.5, came in at 0.3. Again, kind of in line with what we were assuming for that final push into December. Personal income. Personal spending was negative as we were looking at, but the personal income side is going to be concerning as, again, we have the inflation moving up, price moving up, while wages aren't keeping pace. And then the PCE deflator, another one that's looked at, came in at 5.8%. And then on the core side, again, at that 4.9%. And all of that is leading into where is sticky inflation, where's flexible inflation, and that is impacting the sentiment around the country, as we saw in the econ show with consumer confidence, and now with the University of Michigan. So just looking at a quick high level of some of the data sets here, you can see the change in private inventories was a huge mover. And one of the things that we've been kind of driving home is that's lumpy. So it's a matter of when does it show up, and it doesn't mean it's going to come in the next cycle. And that's where, as supply chains have gotten a bit worse again, just given where the some of the distances, where some of the prices are, that's going to put a little bit of a pause on that inventory side. And just to give you an idea, of inventories accounted for a massive share and was actually the second biggest contribution since 1987, to give you an idea of just how big that really is. And that's something that we talked about in the econ show. But now getting to some more of the updated data, the U.S. personal income, you can see it's starting to drift down, and it's being pulled lower by U.S. personal consumption expenditures on the nominal side, and then on the change side, when you look at the real spending, continues to move down as inflation moves up, wages are struggling to keep pace, again, putting that pressure on the underlying consumer. And the reason why that's so important is because when you look at U.S. personal consumption expenditures and PCE, you're going to see where PCE is on the inverted side, and that's going to drive down consumption. And I think that's a very important point when we look at where is consumption, how does consumption go going forward, and what are those pressure points going to be? So when we look at the pressure side of it on the, and I have to turn off my ringer. So when we look at the consumption side, so as PCE rises, it's going to bring down consumption, and as consumption is over 70% of US GDP, it just shows what that pressure is going to look like. And as we've been saying, we don't see a huge drop or at least going into contraction, but again, just showing some of that slowdown into Q1. Now, when you look at U.S. residential fixed investment as a percent of total fixed investment, you're going to see this drop. So we expect to see ISM Manufacturing Index come down, and just shows you the pressure. It doesn't come down right away. I think we get a little bit of a bump because we had employment pretty weak, as we talked about in the econ show, but it just shows you the trend and the pressure that we're going to be in as we go into a Fed tightening schedule. We're going to have rate rises. These are going to be some of those pressure points that will exacerbate these issues. Then when you look at the Conference Board Consumer Confidence labor differential, you can see that typically we're getting to a point that is more in the late side of the cycle, just showing how we are coming to a pivot point, which is going to put some pressure on where equities are, where pricing is, and just where some of the underlying economy sits. And all of this, again, leads to what is going to happen with crude. How are people going to spend? or is there going to be enough money to purchase some of these different entities? And this is why when you look at U.S. personal consumption expenditures, looking at the PC inflation side, so PC inflation was hotter in December, coming at 5.8%, fastest annual rate since 1982. Core PCE coming in at 4.9%, fastest annual rate since 1983. So again, huge amount of increases. December personal income at 0.3% versus the estimate of 0.5%. Spending at negative 6%. So it's the worst month for spending since February of 2021. And now you have insofar in January, you have diesel prices that have gone up. You have gasoline prices that have gone up. Again, keeping these pressures. And I think some of the pause in spending that we're seeing. Now, when you look at University of Michigan sentiment and expectations, we are now below where we were, obviously, at the worst point of the COVID pandemic. And I think this speaks to where people are seeing inflation, where they see their wages, and again, that all leads down to what is spending going to be. And as spending slows, that's a signal for, again, the U.S. economy, and that's coming into a point as we have, government transfers coming down, rates going up, and then when you look at the emerging market, there's additional pressure there. Now, the U.S. dollar is now at 97.28, so we've seen a very large rally in the dollar, which is going to put pressure not only on some of the commodities, but also emerging markets, and that's where we see a lot of that concern as not only crude prices go up, food prices go up, and now the dollar's going up. And again, a lot of these are just going to become bigger headwinds for some of that global growth that we continue to caution on when you look at just what expectations are versus what they will be, as we covered in segment 1 and segment 5 of the Econ Show. So that's what we have for you today. If you're in the Northeast, stay safe. Hopefully, I think we're supposed to get about 12 to 14 inches here, so it's going to be an interesting one. It'll be a good workout, though, and then the kids will get to go sledding. So hopefully everyone has a great weekend. And again, if you have some inclement weather, stay safe. Hopefully everyone's power stays on and you can stay warm. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.